Hello friends, I am Dr. Richa Bhatia from the Department of Commerce, the Bhopal School of Social Sciences. And today I'm here with you to discuss on the topic computation of total income and tax liability of a partnership firm. So now let us start the topic by discussing that what do we mean by a partnership firm. A partnership firm in simple terms is an association between two or more persons who come together to start a business, and their main motive is to earn profit and to divide the profit amongst each other. Now, what is the definition of a partnership firm? According to Section 4 of the Indian Partnership Act 1932, it defines partnership as a relation between persons who have agreed to share the profits of the business carried on by all or any one person who is acting for all of them. After understanding the basic meaning and the definition of the partnership firm, now let us discuss that what are the parties which are involved in the partnership firm. The individuals who agree to carry on the business are known as partners, but collectively, that is together, they will be termed as a partnership firm or a firm. And a document that has all the terms and conditions of the partnership by which the partnership firm is governed is termed as a partnership deed. Now we have to understand the types of partnership. So basically there are two types: limited liability partnership and unlimited liability partnership. Now let us discuss the difference between the limited liability partnership and the unlimited liability partnership on the basis of the various particulars which are given to us. The first one is registration. Always remember that the Limited Liability Partnership is registered under the Limited Liability Partnership Act, or it is also termed as the LLP Act 2008. And when you talk about an unlimited liability partnership firm, it is registered under the Partnership Act 1932. The second basis is registered to. Always remember that the Limited Liability Partnership is registered to the Ministry of Corporate Affairs. And when you talk about the unlimited liability partnership, it is registered with the registrar of the firm. Now, the third basis is that what is the minimum and the maximum number of partners that can be in both the partnership styles. So, the first one, when you talk about the limited liability partnership firm, always remember that the minimum number of partners will be 2. But there is no upper limit. That is, there can be as many members as in the limited liability partnership firm. There is no restriction. And when you talk about the unlimited liability partnership, always remember that the minimum is 2, but the maximum is 20 in case of this particular partnership firm. The fourth basis is the minor partner. Now, can a minor partner become a partner in both these styles? So when you talk about the limited liability partnership, always remember that the minor cannot become the partner. But when you talk about the unlimited liability partnership firm, a minor can become the partner, but there should be 2 adults, right? There should be 2 adults, that is 2 majors, to form a legal partnership. Now let us move ahead. The next basis of differentiation is the liability, and this is the most important differentiation that will differentiate between your LLP and your partnership. Now, what is this difference? Always remember that the name is suggesting that when you talk about a limited liability partnership, the partnership firm and the partners are 2 separate entities. Therefore, the liability of the partner is only limited to the amount which is invested by him. But when you talk about an unlimited liability partnership firm, the partnership firm and the partners, they are not considered as a separate legal entity. And therefore, the liability of the partner is unlimited. I repeat, the liability of the partner is unlimited to the amount of liabilities of the partnership firm. This is the most important and the most basic difference between the LLP and the unlimited liability partnership firm. The last difference is the transferability. Always remember that whenever you have shares in case of a partnership firm, when you talk about LLP, it can be transferred very easily from one person to another. When you talk about the unlimited liability partnership firm, they can be transferred but only after they get the consent of all the partners of the partnership firm. So this completes the basic difference between a limited liability partnership and unlimited liability partnership. Now let us move on to the next topic. Now, to compute the total income and the tax liability of a partnership firm, the most important thing to understand is that whether it is a limited liability partnership or unlimited liability partnership, it is divided into two groups. These groups are most important. The first group is that when a partnership firm is fulfilling the conditions under Section 184. And the second group is that when a partnership firm is not fulfilling the conditions under Section 184. Always remember that when a partnership firm is fulfilling the conditions under Section 184, while computing the profits and gains of business and profession, the interest and remuneration which is payable to the partners by the partnership firm is deductible under the provisions of Section 40, subsection B. But when a partnership firm is falling in the second group, that is, it is not fulfilling the conditions under Section 184, then Section 185 is applied. And what does Section 185 says? That the interest and the remuneration which is payable by the partnership firm to the partners is not deductible while the computation of profits and gains of business and profession of a partnership firm. Now let us see that what are the conditions in which the partnership firm will fall under Section 184. The first condition is that the partnership is always evidenced or supported by an instrument. Now what is this instrument? This instrument is the partnership deed. So the first basic requirement is a partnership deed. The second thing is that in that particular instrument or in that partnership deed, the share of the partners must be specifically mentioned. Then, the certified copy of this particular instrument or partnership deed, supported by the returns of income of the firm for the previous year relevant to the assessment year, must also be submitted. Then the next requirement is the firm, once assessed as a firm, will continue to do so until there is any change in the constitution of that particular partnership firm. If by chance there is any change in the constitution of the partnership firm, then a revised partnership deed, I repeat, a revised partnership deed along with the return of income of that particular previous year should be submitted. If all these conditions are satisfied, then only a particular partnership firm will fall under Section 184. Now, what are the conditions when a particular partnership firm is not able to satisfy this section under 184 and will fall under Section 185? Now, if a particular partnership firm is not able to comply to Section 144, now what does Section 144 says? It is regarding the filing of the returns and also failure to comply to the notices that are issued under the Income Tax Act 1961. So if a particular partnership firm is not able to comply to these provisions, it will not fall under Section 184 and will fall under Section 185. Now, whenever it is falling under Section 185, always remember that no deduction in respect of interest or remuneration or salary or bonus which is given to the partners by the partnership firm will be allowed while the computation of the profits and gains of business and profession. I repeat, if it is falling under Section 185, no deductions will be allowed. And whatever remuneration interest is paid to the partners, they are not chargeable to tax while computing the partner's income. That is the most important thing that we need to understand. So this is the basic difference between Section 184 and Section 185. Now let us discuss the provisions under Section 40B. The provisions under section 40B is related with interest and remuneration. So always remember, when we are talking about interest, interest is allowed to both style of partners, whether it is a working partner or whether it is a non-working partner. And when you talk about remuneration, remuneration will only be given to the working partners. It will not be given to the non-working partners. Always remember, both interest as well as remuneration should be authorized by the partnership deed. When you talk about interest, it must always be paid on or after the partnership deed formulation. Now, the most important point is the limit. This is the most important point. When you talk about interest which is given to a partner, the maximum limit is 12% simple interest. And when you talk about remuneration, this calculation is most important that you need to understand. When you are finding out the maximum limit, the first step is that you need to find out the book profit, that I will explain you with an example in the later slides. So when you are ready with your book profit, how will you find out the maximum limit of the remuneration? On first 3 lakh of the book profit, or in the case of loss. So if you have a loss, or in the case of first 3 lakh of the book profit, you are going to take the amount 1,50,000 or 90% of the book profit, whichever is more. I repeat, 1,50,000 or 90% of the book profit, whichever is more. And then on the balance of the book profit, you have to take 60% of the amount. When you add both these amounts, you are going to get the maximum limit of the remuneration under section 40B. This calculation will have more clarity when we do a practical question in our later slides. Now, before calculation of the book profit and moving on to a practical question, there are 3 basic formats that you should be aware of when you are calculating the total income and then ultimately the tax liability of the partnership firm. The first and the most basic format is how you have to calculate your book profit. To calculate the book profit, the step number 1 will be that as per the P&L account, you need to write down the net profit. To this, you need to add all the adjustments which are given under section 28 to 44D. You are also going to add remuneration if it is debited to the P&L account. You are also going to add the interest in excess of 12%. From these items, you are going to subtract all those incomes which are credited to the P&L account, but they are not related with your business. Once you do so, you are going to get your final answer as your book profit. And on the basis of the book profit, your calculation of remuneration will be done, which I had explained earlier. Now we are going to move on to the next format, how to calculate the total income of a particular partnership firm. So here is the format of calculating the total income and then ultimately the tax liability of the partnership firm. We are going to start by writing down the book profit as we have calculated in our first format. Then we are going to give the deduction as per our 40B, that is remuneration. So remuneration, we are going to subtract least of the following, that is either we are going to take the actual remuneration and we are going to take the statutory remuneration as per section 40B. Out of these 2 amounts, whichever is the least, that amount I am going to subtract for remuneration. Then I'll get my answer for profits and gains of business and profession of that particular partnership firm. I'll add any other incomes from other sources of the partnership firm and I'll get my final GTI, that is my gross total income. Once I'm ready with my gross total income, I'll give the deductions. You are already aware of the deductions, that is from 80C to 80U. Once we are ready with all the deductions, your final answer will be the total income of the partnership firm. In the total income of the partnership firm, you are going to calculate the tax, the rates we are going to discuss in our later slides, and you are going to get the final amount of profit that has to be distributed to your partners. Now let us see the format of the computation of income of partners, which is the last format that we need to discuss. Now the following is the last format for calculation of the income of partners. We are going to take into consideration the remuneration as per the partnership deed. Always remember, as per the partnership deed, 40B is not applied over here. Then we are going to take the interest from the partnership firm. It is exempt under section 10(2)(a). With this format, your computation of book profit, your computation of total income and tax liability, and the computation of total income of the partners will be complete. Always remember, while the calculation of book profit, there are two important points. The first one, if there is any kind of brought forward business loss, always remember it is not deductible for the computation of the book profit. And if there is any kind of a non-business income and any other expense that is related to that non-business income, that is also not considered while the calculation of book profit. Now, once you know the difference between partnership firm, limited as well as unlimited liability, you know the meaning, you know the sections 184 and 185 and all the three formats of computation of book profit, computation of total income and tax liability of a partnership firm, and ultimately computation of the total income of partners, the concept theoretical becomes clear. Now, in our next meet, we are going to discuss the practical problems that are related with the computation of book profit and tax liability of the partnership firm. Till that time, happy learning, keep revising. Thank you.